finance fees, and then there is an operating lease.
There are internal auditors everywhere, then how did that Vijay Mallya fraud even happen?
Gross profit will give me the sales.
Are internal auditors as independent as external auditors?
The concept of initial measurement told us at what value should I record the accounting entry when I first acquire the asset. Now, say for example, I acquired the asset on say 20th of November and I have reached the end of the financial year. I'm standing on 31st of March. Now, the question that comes to my mind is, should I continue to record the item of property, plant and equipment at the same value, at the same cost at which I acquired it? Or is there another method of subsequently remeasuring it and showing it at a different value? So what we are going to understand now is the idea of subsequent measurement. Subsequent means later. Measurement is the value at which I want to show it in my financial statements. Okay. Now, my initial recognition, my initial measurement was at cost, and we did try to understand what all is included in that cost. Your asset is recorded at the cost in terms of initial recognition. Now you have reached the end of the financial year. What is it that you need to do now in terms of depicting that value in the financial statements? There are two ways of doing it. You can continue to use the cost model and continue to show it at cost, or you could choose to use the revaluation model. You might also want to call it the fair value model. When you say that subsequent measurement is at cost, the other day I recorded an entry, non-current asset account debit to cash account 1 lakh. It continues at that amount. We learn about depreciation in a bit, but basically the idea is that it continues at the same amount. In terms of the second model that we have written here, which is the revaluation model, the term itself says revalue, value it again. Now you see I'm wearing this gold ring. I purchased it for some 35,000 a couple of years ago. Today on 31st of March 2024, I have a question that when I purchased it for 35,000, it was at cost basis. It gave me a true and fair view of the amount that I paid to acquire this ring. But today, if I continue to show it at 35,000, don't you think I am contradicting myself and my objective of showing everything at its true and fair value? It's not worth 35,000 anymore. The value of, say, maybe this is 10 grams of gold. The value of the same 10 grams of gold today is 65,000. And if I continue to show it at 35, don't you think I am doing a huge disservice to the readers of financial statements? So ideally, I should show it at its value today, its current value. So if the current value of the same gold ring is 65,000 and I want to bring up this 35 to 65, some of you might end up telling me, sir, isn't there a profit or isn't there a gain? Let's not use the word profit, let's use the word gain. Some of you might say your gold ring appreciated in value and there is a gain. But tell me something, have I actually sold the ring right now? No, it's very much here. Which means although there is a gain, right now I have not realized that gain. And when do I use the term realized? Only when I receive cash against that particular item. If I were to sell it today, tell me if you want to buy this off me. But if you were to buy it from me today, that gain would become realized. Right now, it is still a notional gain. It has not been realized yet. It is my unrealized gain. So can I credit this amount to my profit and loss account? The answer is no. The value of the asset has to go up. So what I will do is, I will debit non-current asset. Let me use one short form here, non-current asset account debit. But what do I credit? We discussed just now, I cannot credit my profit and loss account. I need to find a way. I need to credit some account. So let me credit to reval surplus or revaluation surplus. Now this is not my realized gain for one simple reason. I have not yet sold the ring. which is why this cannot go to P&L. This will get shifted to reserves and surplus in the balance sheet. And when you are presenting your statement of profit and loss account in the OCI section, what is OCI? We have discussed this in the past. OCI is other comprehensive income. It is my income but not yet realized, so I am not crediting it to P&L. I am crediting it to revaluation surplus OCI. Now please bear in mind and try to recollect what we discussed already. OCI is not an account. The double effect, every debit has an equivalent and corresponding credit. The credit effect has gone to reval surplus. The debit effect is in non-current asset. OCI is not an account. OCI is an extension of the statement of profit and loss, wherein I accumulate all my unrealized gains and some other transactions also that we have discussed. Also pay attention to the word I used. I did not say P&L account. I said statement of profit and loss and other comprehensive income. If I use account, it has a debit and credit side. When I use the word statement, there is no debit and credit side. I am putting out certain information for the world to see. Now, the readers of my financial statements know that there has been an appreciation in the value of this particular item. The non-current asset is now worth 65,000, but the gain has not been realized yet, which is why I have parked it in my other comprehensive income revaluation surplus. Are you all with me? Having understood this, let's understand in terms of subsequent measurement one concept which you must have studied in your 11th and 12th, and that concept is depreciation. Now, what exactly is depreciation? I'll tell you something. Someone was messaging me, and this person wanted me to explain the idea of depreciation. You guys use autocorrect so many times. The word changed to depression, and that person never made an effort to change it. But let me tell you, it's depreciation, and it will not give you any form of depression if you pay attention to what I am saying right now. Now, if I keep on using this smart board for a long duration, I will end up touching it. I hope I don't, but what if I knock this over? Something will go wrong and then it will have to be repaired. Maybe its productivity is not where it should be. And simply by hitting it with my pen all the time, after a couple of years, it will lose its utility. So, the concept of depreciation now comes to your rescue. Let's try to understand depreciation from a matching concept perspective. I have purchased this particular item, I have purchased this particular equipment. Okay. Now, when I have purchased it, say in the month of March 2024, do you think all the utility from this will come to me in one go? No. The utility from this particular smart board will come to me for a couple of years. So, when I'm using this smart board, the income from that is getting credited to P&L over 2, 3, 4, 5, 6 years. Now, if the income from the use of this smart board is getting credited to P&L over 2, 3, whatever number of years, don't you think it will be incorrect to charge its entire cost to P&L in one go? I would basically be violating the matching principle that we discussed long ago. So, to take care of that part, what I am saying is, say this is my P&L account. I make videos, I sell videos, and the income gets credited over a number of years. The cost of this asset, the asset which is used to provide this income, uska cost should also get debited to P&L, but not in one go. I need to be systematic about it. Now think about it logically. What is the correct way of allocating this cost? The correct way of allocating this cost is, if I use 10% of this screen in the current year, only 10% of cost should go. If I use 30% in the next year, only 30% of the cost should go to P&L. Why? Because the amount of expense on account of this board that I am debiting to P&L should reflect the pattern of usage. Now, if I were to give this kind of flexibility to everyone, people would manipulate this number to get any profit result that they want. So I cannot give you that free hand, no. I need a systematic way of allocating the cost to my profit and loss account. And that systematic way of allocation of cost of a non-current asset to the profit and loss account is my depreciation. So what is depreciation? It is a systematic reduction in the value of an asset on account of regular use, wear and tear, and other recurring factors. With that in mind, are there any methods for calculating depreciation? Evidently, yes, there are. There is the straight line method. We'll understand why do we call it the straight line method. We have the written down value method. We have sum of years digits method. There are like 100 methods probably out there which try to reflect the pattern of usage. But as I told you, I cannot give you that free hand, which is why I will prefer sticking to a couple of methods. Okay. The written down value method is the next method. Now understand one thing. IAS 16 does not prescribe a method. IAS 16 only says that the method of depreciation, the method of allocation of cost that you choose should in a way mirror the usage of that particular asset. The pattern of usage, the pattern of gaining utility should reflect in the amount of depreciation. Your Companies Act in India will prescribe a certain set of methods. The Companies Act in the United Kingdom might prescribe a different set of methods, but the idea remains the same. Accounting standard IAS 16. India, back in the day when we had AS 6 and AS 10, these two standards also did not specify the method of depreciation. In fact, they are silent. All they are saying is that the depreciation method used should mirror the pattern of utility that you get from that asset. Which is why if I am talking about a leased premises that I want to depreciate, I would use the straight line method. Think about a new Activa that you have purchased. It gives you more utility in the current year and the utility keeps on declining. It breaks down far too often later. It has certain challenges, which stop you from using it to its fullest capacity. So depreciation cost allocation should be more in the earlier years and it will keep on declining in the later years. It is for assets like machinery, plant, and all of that. When I'm talking about a lease, I'm maybe utilizing that building in the same way every year, which is why I call it the straight line method. The amount of depreciation remains the same. With that in mind, let's try and understand how do we calculate depreciation under these two methods before we even talk about the accounting entry. Okay. So my first method, my straight line method, and this is a formula that you as budding chartered accountants should be aware of. What is the formula? The SLM depreciation per annum is cost. We discussed a while ago what do you mean by cost, minus estimated residual value upon estimated useful life. Be careful, I'm using the words estimated. I do not know for sure for how long this asset will last, but I estimate that I will use my Activa for 5 years. Being an Indian middle class person, I might stretch it for 10 years. I shouldn't, but I might, who knows. So this is my first formula for calculating the straight line depreciation. The second method is your written down value method. Okay. Now, the written down value method or the reducing balance method works slightly differently. Okay. Say for example, I purchase an asset for 1 lakh. Okay. What is the purchase cost? 1 lakh. I tell you that my rate of depreciation is 10% written down value. So, less depreciation year 1. 10% of this comes to 10,000, and I hope you are not using the calculator for calculating 10% of 1 lakh. How much does this come down to? The value which was earlier 1 lakh has been reduced or written down to 90,000. Okay. This is WDV at end of year 1. Okay. Now you move into the second year. In your second year, again you want to calculate 10% depreciation. But now this 10% will not be on 1 lakh, it will be on the written down value, the depreciated value, which is 90,000. Depreciation year 2 minus 9,000. And I hope you do not use the calculator for the next part. Exam mein please use it. Don't trust your guts. Just follow the calculator. But here the value will be 81,000. And in year 3, the next 10% will be calculated on this 81. This method of calculating depreciation is known as the written down value method. Some of you might want to ask me this question, where is the 10% rate coming from? It's not a figment of my imagination. There is a formula to calculate that as well. Is it required in our exams? No. But we do need that basic computational ability to be able to calculate this depreciation. Okay. Now that you have calculated depreciation, you should focus on what should be the accounting entry. The accounting entry, depreciation is an expense or a loss of value. What does the rule for nominal account say? Debit all expenses and losses. So, I will debit depreciation. Depreciation, debit. To the value of my non-current asset is decreasing. Non-current asset had a debit balance, the value is going down. So I credit my non-current asset. This is my accounting entry for recording depreciation. Now, is this the only accounting entry? No. You are doing a professional course. You should know the different ways of expressing the same accounting entry. The net impact is the same, huh? Don't worry about that. This is my method 1. There is another method of calculating depreciation. Not calculating depreciation, my mistake. Another method of recording the accounting entry. Okay. Let's see what that is. The debit effect is same. It says depreciation account debit. But instead of now crediting the non-current asset, I will credit a different account called accumulated depreciation. Accumulated means total from the beginning till now. Okay. To accumulated depreciation account. Now, what purpose does this serve? If I were to ever ask a question, what was the original purchase cost and to what it has fallen down to today? If I were to ask you that question and you were recording depreciation using this accounting entry, you would have to open the fixed asset register, you would have to open the ledger, go back a couple of years and then tell the world, okay, I purchased this asset for 1 lakh. Depreciation charge till date is 19,000 and the value today is 81,000. But if I want to show the world in one go, if I want the readers of my financial statements to know what was my initial original asset base and from inception till date, how much depreciation has been charged, the way I present it in my balance sheet makes a lot of difference. What I am going to do is, I am going to write down assets. How much? 1 lakh. From that, I will subtract accumulated depreciation till date. In year 1, I charge 10,000. In year 2, I charge 9,000. What is my accumulated depreciation? 19,000. And after this, in the outer column in my balance sheet, I will write down a neat 81,000. When I look at this information, the users of financial statements know what was the initial cost, how much depreciation has been charged from inception till date, and what is the written down value. If they want to know what is the depreciation charged in the current year, they might as well go to statement of P&L and find out. So this approach helps me in better presentation of data. I hope you are with me so far. Now, having understood depreciation, we will move into other aspects of non-current assets, tangible non-current assets under IAS 16.